welcome back everyone. So we'll now turn to the Nedgroup Investments Stable Fund, which is the perfect solution for investors looking for an inflation-beating return objective, as well as a strong emphasis on capital preservation. Joining me now is Nick Balkin. He's the South African CIO at Ford Asset Management and a portfolio manager at the firm. Nick, welcome.
Thanks for having me.
Nick, so just before we get into some of the details around performance and attribution and so on, are you able to just share some of, let's call it the core objectives of how you manage the fund and what it's trying to achieve and how you think about risk within the portfolio?
Yeah, our objective is to achieve inflation plus 4 over the life of the portfolio. And we've done that over most time periods. We also do that at the same time, but not losing money over 12 months, which you can see since the inception of the portfolio is an amazing achievement.
No, definitely. I mean, I do want to talk about those points in a bit more detail just now, and we'll get to that shortly. And you mentioned about performance as well. I mean, can we just pause on that for a second? I mean, if you look at returns over the last, various 3, 5, 10-year periods, you've actually done very well against inflation plus 4, which is quite a difficult benchmark. And as if that's not difficult enough, we've given you this capital protection objective on top of that as well. But looking at, let's call it your return signature, you've actually achieved those objectives very consistently over time. So, I mean, any comments on that? How do you kind of manage the twin objectives?
Yeah, listen, it is something that some people always ask us because it is a bit of the secret sauce. And I think the one thing is at the start of it is to not be benchmark cognizant. It's to understand that there's correlations in assets and to try and understand that when one asset is doing really well, something might not be doing well. So it's a portfolio construction idea that we understand where risk is. When you're losing money, maybe gold will help you. When gold's not doing well, you've got something else to help you. So most people silo and think about their portfolio in equities, fixed income, property, etc. We see the interaction between the different asset classes and we understand maybe when one's not doing well, the other will really give a helping hand.
Because I know you and your team are very conscious and disciplined about constructing a portfolio for different outcomes in the future. You're not kind of hanging your hat on one thing has to happen and then only you'll do well.
Well, it's the way we think about it. It's probabilistic. So we always have a view of where the world is going. We'll have a view of what's happening in Iran, but we'll have different scenarios. If it goes on till this date, if it goes on to this date, what happens? You have to think about the world in a probabilistic point of view. And if you do that, you understand that if I'm wrong, so you can have your base case, but if I'm wrong, what happens to the portfolio? So a lot of that thinking doesn't always come through, but there's certain times in the world where you can prove that happens.
Yeah, I mean, maybe this past quarter was one of those times when your probabilistic thinking actually worked very well. I mean, you've done so well relative to the peer group over this past 3 months or so, but it's such a almost perfect example of the way you think about being conservative, managing risk within the portfolio. I mean, any comments, please?
Yes. So as I was saying, I think this is exactly the example of people would use a building block. So the other stable funds would say, okay, I have a 40% equity allocation. Let me go and get the benchmark or the CAPI and, put in the CAPI for the SA equity. Let me put in the S&P for the global. That's not how we work. We build the portfolio up. The equities we have in the portfolio are chosen for the attributes that the stable fund have. If we have a company like Premier, it's in there and we have it because it's staple, it sells bread and it continues to compound nicely. Do we want to be the same as the benchmark? No, we want to be very different to the benchmark with selected stocks that are attributes. And when you do that, you have confidence that there's actually underlying value in the things that you're buying rather than just getting the benchmark performance and kind of inputting it. So I think that's why we have the confidence that these portfolios are so resilient when tested.
Yeah, I mean, certainly one of the things we love about you guys actually is the fact that you don't have one house view, which let's call it transcends every single mandate. You're actually specifically choosing companies and asset classes for that mandate specifically.
100%. Our equity fund would have very different equities in the equity fund that we would in our stable fund, in the Nedgroup Stable Fund. So absolutely bespoke stock selection to do exactly what we want for the benchmark that we're trying to achieve.
And Nick, I guess just coming back to something you mentioned about earlier as well, just the capital protection objective of the fund over rolling 12 months. I mean, it is actually astounding that you haven't actually breached that 0% level. I mean, in the asset class modeling that we've done, I mean, even before we appointed you guys, I mean, what's it, almost 20 years ago? It's approaching 20 years now. So even before we appointed you guys, we've done so much asset class modeling around that. And in a low equity type mandate, you could actually have a minus 15% return over a rolling 1 year period. And you've also seen that with some of the competitors.
Totally. So we understand who the underlying investor is. That's why one of the objectives when you have drawdowns, you need to understand that you don't want to have that losing. You know, you can have a stable fund, but there's people drawing money off the stable fund all the time. So you need to understand there's a certain attribute, and that's where that don't lose money comes from. So as I was saying, you've got the SA component, but we think that if you think about it quite deeply and you understand that there's the offshore component and the SA component, and everyone looks at, we act almost maximum weight in offshore. And people always say, but Nick, from a stable fund point of view, does that not add any risk? And I say to you, I explain, if you understand there's a certain correlation between domestic equities and the foreign component, and when the one's doing well, the other's probably not doing well. So when you look at it and analyze on a silo basis, you'll have certain comments. But when you actually look at the portfolio holistically, then you absolutely will understand what we're intending to do.
Like how it all fits together.
Yeah.
Yeah, and you actually see that in the attribution analysis, for example, right? Like over time, different components have either detracted or contributed to returns.
Yeah, but that's where the 12-month protection comes from, is you need to know the correlations of your different asset classes. You need to know the correlations of the stocks. When we drill down, if we have a certain overweight in China in our global component, we'd make sure we don't have that in our SA component, because some of the people that manage these funds wouldn't actually have full view into the overall portfolio. We know what's happening on the one side, and we make sure if there's an overweight in one thing, we'll make sure that we compensate to a certain extent on the other side.
Yeah, that's brilliant.
Yeah.
So I guess just turning to, let's call it the exceptionalism of the US, or the optical illusion of the exceptionalism of the US. I mean, there's so much money going into AI at the moment, right? And it makes the US economy look amazingly strong.
Yeah.
But if you drill deeper into that, what does it actually look like?
Yeah, listen, as you can see, it's all about AI at the moment. If you look, the GDP growth in the US ex-AI is non-existent. You can see that every bit of GDP growth that you have is just due to the AI spend. Right now, we're not even clear if the AI spend is going to be efficient. We know that the accounting of all the Mag 7 is not correct. They depreciate in their AI data centers in a very, very aggressive way. And I think that we overstating what the earnings are actually on the S&P. So underlying, the S&P is actually still a very high rating, and it's a very fragile economy. As you can see, the GDP and the fixed capital formation is pretty non-existent without AI. So I would say it's a weak underbelly.
I mean, any comments on all the guys, I guess, chasing momentum at this point?
Listen, momentum can sometimes be a good thing if a company is executing fundamentally. The problem with momentum, which becomes a problem, is you're worrying about what the benchmark is, and you're worrying about what your peers are doing, and you're worrying about some share doing well that you can't participate in. Sometimes there's a certain thing that, a company is doing well, but the fundamentals are getting better. That's okay. The problem is most people are in momentum for the wrong reasons. They're in there to protect their job. They're in there to protect not missing out on something that could be very exciting. The one thing that we've learned at the Stable Fund is that it's all about slowly building up your wealth. It's not about compounding at 40% per annum. We know that doesn't happen sustainably over time. And you can enjoy those 200% gold returns in a year, but we know that's not how markets generally work. So slow and steady generally does win the race. When you buy good quality things that can continuously go up, there'll be momentum stocks that will do better, but eventually everything kind of normalizes.
I guess the question is, do you want to be one of those guys who normalize very quickly and rapidly and like shockingly, or do you actually want the stable growth, right? Which is what you guys do.
Yeah.
And then Nick, I guess just turning to, let's say, private credit and high yield, which you guys don't really play in that space, but it does have broader implications for asset class returns and volatility globally. Yeah. Any comments on that, please?
I think, to me, it's another signal of that momentum type trade. It's a fear of missing out. Anyone who is in the fixed income market, the way it works is generally it's hard to differentiate if you're in fixed income in the US. Say you earn 6% or 7% or 8%. Private credit is a way to get you a certain extra percent over your peers, over other people, but it comes with the liquidity issues, and none of them are really doing the diligence on their private credit. So we're seeing an unwind in many of the funds where they're gating the underlying investors to stop them coming out. Not only that, the prices are halving of those listed units of Blue Owl and KKR's private credit. So we're seeing it actually underlying, but the reason people were there is because they were trying to enhance their earnings by a few percent, which would never get involved in. There's obviously a level that we would be interested in it, but I would say it's about 600 basis points away from where the yields were.
Definitely. And then, Nick, I guess if you just look at all inventories at the moment, right?
Yeah.
What's the impact? I mean, we're seeing daily news flow about news coming out of Iran now. What are your thoughts on that?
Yeah, I think it's a moving target, what's happening in Iran. I feel it's a bit complacent. I think the market is being quite complacent. I think there's obviously ups and downs, and we're seeing potentials for a ceasefire. I think the damage is done. The truth is, if you look at the inventories, simple English, if you see the global inventories drawing down, which are happening because there's less than 10 million barrels out of a 100 million barrel market that's not actually being produced. Remember, Kuwait and Iran and Iraq and most countries, Saudi is actually a bit more shielded, have to stop producing because they've got no more storage. So that's what happens. 10 million barrels are not being produced that they should. The market is drawing down on all the inventory, and the risk with that is at the levels that we're at right now, we probably should be at $110 to $130 barrel oil of the level of inventories floating around in the global market. The problem is if we stop today, we know that there's not only oil problems. The problem is actually LNG. The problem is fertilizer. We've seen that China have stopped exporting sulfate and a whole bunch of other sulfurs and a whole bunch of other things. So I think the problem is a lot deeper. And I think the biggest problem is a lot of the stuff on the water is still being delivered. So, and just one last point on this. The current delivery of oil that we see, say Brent is 100 right now, people are paying around an $8 to $10 premium to that level just to secure a tanker. So I think the damage is done. I think on a probabilistic point of view, there's more downside than upside. And I think this is the time to actually have a very cautious positioning. You still want enough equity. So just to be clear, the way I said it at the beginning, we had like 37, 38% in equities. And people will once again ask, isn't that high? My question and my answer back to that is, it's always what equities do you own? If you own NVIDIA, it's very different to own Premier. It's very different if you own Netcare, a hospital group. So I think, and that comes to how we started the conversation, is that if you have that view of fundamental investing that has an income, that has a moat, that has a way to understand what that income will grow to, then you can protect your investor. It's not about whether you have so much equities. It's not about how much foreign you have. It's actually what are the underlying components and what are you doing with them that's more important.
No, I fully agree. And obviously understanding the impacts to revenue and earnings of those companies. And I guess just turning to South Africa a bit now. Yeah. So obviously the impact of everything we've spoken about and the impact on inflation, do you think that the market is fully appreciating how bad inflation could get?
Yeah. So there's a huge correlation. I mean, so in the South African inflation basket, petrol is only 4% of the inflation basket. The problem is what we're seeing in diesel specifically is that the crack spread. So there's obviously the diesel price, but then there's the cost to refine the diesel. That has gone to $70. That is a crazy number. So we've seen the diesel price double. Yes, the government's trying to help everyone by 3 Rand. There's still more to come once the next month's increases come. So we're seeing a near doubling of the Rand diesel price in South Africa, which basically goes into every ShopRite truck that delivers food to the ShopRite. So if that's happening, there's going to be a huge implication for inflation in South Africa. And as I said, the adjacencies of fertilizer are yet to hit us. The adjacency of explosives going up are yet to hit the world market. So I think there's going to be a longer tail to this inflation than people think.
And Nick, I mean, just on that point as well. So just, let's call it monitoring the portfolio from month to month. I've definitely seen your ILB exposure going up as well as nominal bond exposure going up. Do you want to talk through that?
So that's a relatively new, so one of the things that we've been buying more recently are the 29 inflation linkers. I think it's quite a nice way to protect your investor. You don't actually have to make a call on what the long-term inflation is right now. 29 inflation linker is just matures in 2029, so it's a relatively short duration. We were able to buy that at 3.95 real, which is almost 4% over inflation. And as I said, if we're expecting 5% inflation and you're getting 4, you can lock in around 9% to 2029. So I think it's a very good risk-adjusted way to deliver a solid building block of your portfolio. That's what we've been doing there. What we also did was in the last month, we saw the longer bonds, fixed coupon bonds, which are we haven't had much exposure to, blow out quite significantly. What's beautiful is if you keep a very liquid portfolio, you're able to react quite quickly. And we were able to buy some fixed coupon bonds at a really good price. I think we've already made 70 basis points, which in maths probably translates to about 6% return on those fixed coupon bonds that we bought in the last 3 weeks. So I think that's what happens. You have to build a steady portfolio, a strong chassis, stay liquid, and then when there are dislocations, use that liquidity to take advantage of maybe the guys are forced sellers.
And then Nick, I guess just turning to your equity exposure then, I think a couple of months ago it was like very evenly split. I mean, you're now seeing a lot of that shifting away from the US towards, let's say, South Africa and Asian equity.
Yeah, I think the SA side of things is very interesting to us. I think it continues to be a very stock-specific, rather than just, you can't just say that it's, because if you go look at the CAPI, the golds, etc. are big. We don't have that as our SA equities is the same as the CAPI. So because we have confidence in those mid caps, we have confidence in strong SA incorporated shares. We also have the belief that the Chinese economy is going to stay strong. It has more than $1 trillion surplus. And actually, if you see what's happening, they're getting stronger from an export perspective. So we're getting the opportunity to buy Chinese stocks at less than 10 PEs. We got the opportunity to buy South African stocks at less than 10 PEs, whereas you have the S&P still over a 20 times multiple, even though it's retraced, and everyone's talking about the Mag 7 pullback or whatever. It's not really a pullback relative. The opportunity for us, valuation-wise, is absolutely outside the US.
Nick, I guess just to finish off then, any comments on outlook across the different regions and asset classes, please?
I think the key point that I want everyone to take away is there's enough in the portfolio. As you said, there's more than 20% linked to inflation-linked bonds. We've locked in close on 4% inflation BT returns out of that. The way we've structured the portfolio, we have high confidence that we're going to generate good inflation BT returns. We are going to have a nice, solid weighting in equities that's going to help us do that by almost a 40, but making sure they're solid equities so we don't have that pullback. And that's why when we look, even with our caution, I started and I said, we're cautious about the world. The way we've structured the portfolio, we think we can continue to tick along very nicely and continue to achieve inflation BT returns into the future.
Brilliant. Nick, thank you so much for joining us.
Yeah, cool. Thank you for having me.